Okay, well, hello everyone. Again, this is Sam Lanzafame, and I'm here to help you out with understanding how to do credit card transactions. I'd have to say, of all the material that is in the unit involving accounting for receivables, I would say this one is probably the least difficult of the bunch. But for everyone, things are different, to each his own kind of thing. But let's go ahead and take a look at this. This is a short video, and hopefully you will feel very good about this material when we're done. So let's review where you see number one over to the left, where I have sales on account to a customer. Keep in mind that when you have a sale on account, that the procedure is you would debit accounts receivable and whatever that customer name happens to be. Let's just pretend we have a $100 sale and we would credit sales. This transaction comes about just as if, let's say a customer calls you up or another company calls you up and wants to buy something from you, and they just say, hey, can you bill me? Can you invoice me? And this transaction gets created from that environment. If we were under perpetual, we would need another entry where we would debit cost of goods sold and credit merchandise inventory. So I will do that this time. And let's say this stuff that we're selling for $100 actually cost us $40 to acquire it ourselves. So we're making $60 worth of profit. So there's your first transaction. All right, we'll put this in a particular color. So that's something that you've known probably since the first time you were exposed to merchandise accounting. All right. So now let's take a look at what the transaction would look like if a customer came into your store, right, and used your store card. So let's say, for example, this is J.C. Penney, and a customer comes in and uses their J.C. Penney card. Or let's say, they want to use their Target card in Target. So they're using a store card. Well, believe it or not, the transaction would look the same. We would debit accounts receivable, and we would credit sales. So you would not know any difference whatsoever from the entry we just did in number one. So you've known number one for the longest time. You instantly know how to do sales when a customer uses their credit card, and the credit card is a store card. So you already know how to do this. So isn't that great? So far, no change in the way things are being recorded. But now, let's take a look at what happens when customer comes in and uses a bank card. An example of a bank card would be Visa or MasterCard. So totally different type of card than the one we looked at in number two. When a customer uses a Visa or MasterCard, Visa or MasterCard instantly deducts basically a fee from the transaction. But this is kind of interesting. Check out the debit. We actually debit cash when a customer uses their Visa or MasterCard. We would also incur some type of credit card fee. We could call it credit card expense, credit card fee, and this would take place at the time of the sale. We want to make sure that we adhere to the matching principle of when to record expenses in the period in which we record the sales. So let's pretend that the rate that we're being charged by the credit card company is 3%. I'm completely making that up. That's negotiable. That would be decided between the company and Visa or the company and MasterCard. So what we can't deny from this is that we have a $100 sale. But Visa or MasterCard is going to keep 3% of that 100, which means we get $97 from this sale. So even though in the previous two, we're going to collect 100, at least we hope to, when we have a Visa transaction, of that 100, we only actually see 97. But the advantage is we don't have to go after that customer. We don't care if that customer, defaults somewhere down the road. It's not our problem. It's not our customer. That customer is now Visa or MasterCard's customer. So from our point of view, this is like well worth the $3 because we lose the headache of having to collect the money. However, in number two, like JCPenney or Target or any of these other stores, department stores or what have you, they like to push their credit card to have you use it in their store because the amount of interest they will gain from you sometimes will outweigh and will be greater than the actual sale itself. So like if you bought a home, let's say for $100,000 and you took out a 30-year mortgage, by the time you're done paying the interest and the principal back, in 30 years you'll probably end up paying $300,000 for that $100,000 home. So it's worth it for people to loan you money because of the interest they will collect from you. So, but again, the only problem is it's a risk. Will you see that to the end, or will you die or file bankruptcy or just be a deadbeat or lose your job, whatever the case may be. Take a look at the second entry. Second entry is the same in all of these. We will debit cost of goods sold for the $40, and we will credit merchandise inventory for the $40. Okay, and the fourth and final one is what happens when a customer uses a bank card. Excuse me, a non-bank card. So a non-bank card would be like Discover or American Express. These are not banks. These are just companies that offer credit cards and people can use them, blah, 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 blah. Let's pretend that this is 2%. So when a customer comes in and uses their Discover card, Discover now becomes our customer. So we would debit accounts receivable dash Discover because we now need to collect money from Discover. And let's say we're going to get $98 from them at some point. We still are incurring a fee to Discover. We just aren't getting the money instantly like we do with Visa or MasterCard. And then we're going to credit sales for the $100. Entry number two, again, assuming we are still under perpetual, you would debit cost of goods sold and credit merchandise inventory. And there you have it. That's how you do credit card transactions. So the first scenario you've known for quite a while if you've been taking accounting courses. The second scenario is new, but it's exactly the same as the first scenario. So when customer comes in and uses their store card, it's the same thing as just selling on account. What's really, really new and unique are the last two. So when a customer comes in and uses their Visa or MasterCard, which is a bank card, we instantly get cash in that transaction, but we incur a fee. So that reduces our cash flow instantly, but at least we have instant cash. And then in number four, when a customer uses a non-bank card like Discover or American Express, we still incur a fee. However, American Express or Discover is now the customer that we will then bill, and we'll probably end up like accumulating all of our Discover receipts and probably mail them maybe once a week, and then when we get the money, we'll debit cash and we'll credit the accounts receivable. Okay, that's it. So thank you again. This has been Professor Sam Lanzafame. I hope that you understand credit card transactions and hope to see you again in a future uh, video. And I think the next topic we're going to be getting into is depreciation. So stay tuned for that. Have a great day, everybody. Bye bye.